Hi, good morning. We are going to start the webinar now. Uh, Doing a sound check, testing. Okay, we'll start the webinar now. If you can hear me, type something. Okay, good. So we can proceed now that a few people have um, responded that they can hear me. Okay, so I'm Richard, analyst covering the transport, logistics, and industrial REIT sector. Disclaimer. Okay, so I'll start off quickly by talking a bit on the results that came out last week. So 800 Super is under our coverage. We have a buy rating, target price 66 cents. Last close was 47 cents on Friday. So you can see they reported their full year results. Their financial year ends in June. Revenue was 140 million, 22% increase from 115 from the previous year. This was due to award of new contracts and re-award of existing contracts at revised pricing. Bottom line, PATMI, we'll look at this line, the adjusted PATMI of 12.2 million versus 9 million the previous year. This is adjusted to exclude a 5.4 million one-time gain from disposal of property. So 12.2 is the recurring PATMI. You can see that they had a 35% increase year on year for PATMI, and they have declared a 2 cents final dividend. This represents a 29% payout from accounting profit, and it's a 4.3% yield based on last closing price. I just have 4 key points for 800 Super now. So they had a sizable contract win by MHA, Ministry of Home Affairs. This contract is worth 38.6 million and is for 3 years. So on average, it would be 12.9 million revenue to be recognized annually. So if you look at this 140 and you compare 12.9 million, it's just under 9% of revenue. So this MHA contract alone should increase their annual revenue by about 8 to 9%. The other one is their Southwest Region Integrated Public Cleaning. That contract already kicked in from second half of last FY, and so this MHA contract and the IPC contract will propel revenue further in FY 2016. The other thing is they have announced within the filing is that they have started on their biomass plant. What this is essentially is actually an incineration plant specifically for horticultural waste. So this 800 Super, they have 3 business segments. One is the refuse collection, one is cleaning, and the other one is horticultural services. That's just a nice way of saying gardening. So they do gardening for schools and they are one of the end parks contractor as well. So gardening will be like tree pruning and grass cutting. So they have all these horticultural waste, and so instead of bringing it to the NEA incineration plant, they will bring it to their own biomass plant or waste to energy plant and incinerate this horticultural waste there, and at the same time they will generate some energy. So this will result in better integration of the business, improvement of margins because of cost savings. And so final bullet point why we like 800 Super is because it's non-cyclic. It has a non-cyclical and defensive business model, which is really some value proposition in this time of volatility. And then they have resilient earnings and a superior ROE, which is around the low 20s. Okay, next I'll move on to the main part of today's webinar, which is I'm going to elaborate and talk about our hospitality sector, which we published last week on Thursday. The key content is actually the STB data for June, which was released on Tuesday last week, and we published a report on Thursday. So with the June data, we actually can look at the 2Q data as well as the first 6 months data. So this is the snapshot for 2Q. Our international visitor arrivals into Singapore was flat. There was a 0.5% year-on-year decline to 3.62 million visitors. The three hotel key metrics, which AOR, ARR, and RevPAR were lower. They stand for average occupancy rate, average room rate, and revenue per available room. So these three metrics were lower. What happened was hoteliers had to lower their rates due to the flat visitor arrivals and combined with the oversupply of new rooms. One of the key positive points for the 2Q data shows that there was a strong rebound in Chinese tourist arrivals. There was a 40% growth year on year, but I'll go into more detail. We don't think that this 40% year on year growth is sustainable. We'll go into more details in one of the later slides. Also, India has displaced Australia as the fourth largest market coming to Singapore for first 6 months of this year. I'll go into more details of that and to clarify something about that as well. So the bottom here, this table is just a summary of the visitor arrival numbers as well as the three hotel metrics. So as I mentioned earlier, international visitor arrivals is down 0.5% for the quarter year on year. Average occupancy rate for the hotels is 82.8%. Last year was 83.5. Average room rate 240.8, and last year was 255.3. RevPAR this year, second quarter, 199. Last year was 213. So one thing that I want to point out is that if you look at the international visitor arrivals, for the quarter it was flat at negative 0.5%, whereas RevPAR was significantly lower at 6.5%. So this really shows you that the effect of the oversupply of new rooms. So our outlook. So what we think is that, okay, firstly, we think that international visitor arrivals this year for 2015 is likely to experience negative growth. STB has forecasted 0 to 3% growth, but for the first half year or for the first half of this year, we are already down 3.4%. And so for the remaining 6 months of this year, they would need to see visitor growth by 3.4% in order just to have a flat full year of 0% growth. And this 3.4% is even more aggressive than the optimistic top range of STB's 3% forecast. So that's why we think that we are going to have a year of negative growth, and this would actually be the second consecutive year. In 2014, we also had negative growth versus 2013. Our expectation is that the relatively strong Sing dollar will be the key impediment to visitor arrival growth, as already is existent that Indonesia, Malaysia, and Australia are really having a negative growth in visitor arrivals coming to Singapore, and they have their domestic currency has been weakening against the Singapore dollar. What the hoteliers are saying is that they expect a competitive operating environment due to weak visitor arrivals, soft corporate demand, and the upcoming supply of hotel rooms. So for hotel rooms, the hoteliers are saying that they are forecasting 5.9% to 6% growth in the number of rooms over the next 3 years. So you contrast with STB forecast of 0 to 3% growth for visitor arrivals. It's obvious that even at 3%, the number of visitors coming in are not going to be able to soak up the excess supply of new rooms. As of the end of 2014, there were about 57,000 rooms, and then for the additional rooms in 2015, 16, and 17 will be about 4,300, 3,600, and 2,400. On a brighter note, the hoteliers have cited the initiatives, attractions, and events that they expect to draw leisure and corporate travelers. So some of these examples are the marketing campaigns by STB and like the 20 million joint campaign between SIA, STB, and Changi Airport Group to promote Singapore as a leisure, business, and MICE destination. Singapore Botanic Gardens was declared a UNESCO World Heritage Site, and there will also be various sporting events in the later half of this year. Now I'll go a bit deeper in the various numbers for the sector. So as I said, visitor arrivals were flat in second quarter of this year. That's April to June, and then this is our seventh consecutive quarter of flat to negative growth. If you look here, this chart shows the visitor arrivals coming to Singapore. Each bar represents 1/4 of visitor arrivals, and so this is 2Q15, and here is a 0. So you can see that there were 7 consecutive quarters of flat to negative year-on-year growth. On a 6 months basis, we have a 3.4% decline year-on-year. So first 6 months of this year, there were 7.26 million visitors compared to last year. First 6 months, there were 7.52 million. You see these numbers here as well. Our top 5 markets remain unchanged. They are Indonesia, China, Malaysia, Australia, and India. I'll draw your attention to these numbers here. So you can see Indonesia, this column here shows the visitor arrivals in second quarter of this year. This is showing second quarter of last year. This is showing the first 6 months of this year and first 6 months of last year. So what you see here is that for Indonesia, Malaysia, and Australia, they're all showing negative year-on-year growth for the quarter and for the first 6 months. And then in contrast, for China, second quarter there was a 40% growth, and for first 6 months, 8.9% growth. India, 7.9% growth year-on-year for the quarter, and 5.7% growth for the first 6 months. So what happened is in the first 6 months, actually, India has displaced Australia as our 4th largest market. And as Indonesia, Malaysia, and Australia continue to be bogged down by depreciation of their own domestic currency. I'm going to clarify a bit on the Australia and India market size. So for first quarter of 2015, Australia contributed a larger proportion of visitors compared to India, and likewise the same quarter last year. And then it's a seasonal effect where in second quarter, India will have a larger market share compared to Australia. This is what we see this year and last year as well. Here you see India 8.1, Australia 7.1. So in second quarter, India is usually having a larger market share. But what has changed this year is that for first 6 months, India has overtaken Australia at 7.2 compared to 6.8 for Australia, whereas last year Australia was 7% and India is 6.5%. So this chart is showing the market share by nationality for second quarter of this year. So India is here, is ranked number 4 compared to Australia, and this is also represented here in the orange bar here, Australia here and India here. So you can see if you look at the blue blue and blue and orange. For second quarter, there's actually no change in that. Second quarter usually is a strong quarter for India where they will have a larger market share compared to Australia. But if you compare here, this is for 6 months, first 6 months of this year, and if you look here, Australia for first 6 months of 2014, the blue bar was longer than the one for India, whereas now for 2015 for 6 months, the orange bar for India is now longer than the orange bar for Australia. So that's where visitors from India have displaced the visitors from Australia. This is only for the 6 months basis. The 2Q basis is a seasonal effect which happens every year. The other positive points come from the strong rebound from Chinese tourists, 40% growth. You see that here. But one thing I caution is that probably this will not be sustainable, because if you look same quarter last year, 2Q14, this was actually the lowest visitor arrivals that we've ever seen from Chinese tourists. So probably this 40% growth is due to the low base effect. Continued growth from Indian tourists, 7.9% growth this year. You look here, and 0% is here. So we have actually already had 4 consecutive quarters of positive growth in visitors coming from India. On the other side, we have Indonesia, Malaysia, Australia. So 0% is here. Indonesia, 4 consecutive quarters already of negative growth. Malaysia, you can see 6 consecutive quarters. Australia, 7 consecutive quarters of negative growth. Now we look at the currency for these top 5 markets. So Indonesian rupiah, Malaysian ringgit, and Australian dollar. You can see that the Singapore dollar has appreciated over that period for the second quarter of 2014 to second quarter of 2015 for these 3 currencies, whereas for the CNY and Indian rupee, the Sing dollar is actually somewhat depreciated over the same period, the second quarter of 2014 around here to the second quarter of 2015. That's where the arrows are showing. Now we move on to the Singapore hotel statistics. So average occupancy rate for the quarter was lower both year on year and quarter on quarter to 82.8%. This is 0.7 percentage points lower than the near-term low of 83.5%, which was exactly 4 quarters ago in the second quarter of 2014. Point out to you that also the axis here doesn't start from 0, here doesn't start from 0, it starts from 220, and here starts from 180, but it's just to emphasize the trend of the lowering ARR and lowering RevPAR. So average room rate has sunk to the lowest level in 4 years. It's 5.7% lower year on year to $24.80. Reason is the flat visitor arrivals that was exacerbated by oversupply of new rooms. Consequently, RevPAR 6.5% lower year on year as a consequence of the lower occupancy and lower average room rate. So as I mentioned in the beginning of the presentation, you can see that RevPAR is lower 6.5% compared to 0.5% visitor arrivals, and this really underlines the effect of the oversupply of rooms, where the RevPAR drops by 6% despite only a 0.5% decline in visitor arrivals. This is our sector outlook, so nothing new from the last quarter when we published a report on the 18th of June. Back then, we said that we expect the Singapore hospitality pure play portfolio to underperform their peers. So we have plotted a graph of the relative price for each of the 7 hospitality REITs, rebase them to 1.0, and we started from 18th of June when we had our previous quarterly update report for the sector. So as of last Thursday, you see that the prices have clustered into three different ranges. So this one is 0 to 3% decline. This is 10 to 15% decline, and this is more than 20% decline. So at the top here, Ascot REIT and Sizen REIT have come out relatively unscathed. OUEH Trust in the second cluster and had about 10% decline in price, and Far East has been the worst performer with 21% decline in price. So OUEHT and Far East HT were the two REITs that we identified having a portfolio which is exclusively located within Singapore. And so you can see that Far East really underperformed the entire subsector, and OUE was in the second cluster. So this table shows the 7 of them arranged by market cap, price, price to book, and their trailing yield. Okay, I'm going to start to wrap up on the topic of the outlook. So we'll start with the headwinds for the sector. So as I said earlier, relatively strong Sing dollar will be the key impediment. We are already seeing that with the lower visitor arrivals and the weakening currency of Indonesia, Malaysia, and Australia relative to Singapore dollar. What the hospitality S-REITs are saying is that the corporates are having a cautious outlook towards the business environment, and that's resulted in soft corporate travel demand. So that's why demand has been lower for their corporate bookings, and this will impact the MICE segment. And again, can't emphasize enough oversupply of new hotel rooms. So visitor arrivals are flat, but there's a lot of rooms coming in, and this would exacerbate the existing supply-demand imbalance. So hoteliers would have to lower their prices in order to maintain occupancy, and this would put downward pressure on RevPAR. Again, the last bullet point here is not new. We mentioned it in our last quarter last quarter update. There was a 9.3% plunge in tourist receipts from shopping in 2014. This is attributable to lower visitor arrivals and the strengthening of the Sing dollar. So you can see that the plunge in shopping is 9.3% in contrast to the decline of 3% in visitor arrivals. So it's quite significant. Tailwinds for the sector is we are still seeing robust visitor arrivals from China and India. There was a strong rebound from China. Probably we'll see further growth in visitor arrivals from China, but obviously probably not up to the level of 40%. And we are also expecting continued growth of tourists coming from India. Changi Airport has offered reduction and rebates of aeronautical fees. This is to attract airlines to come and land here, and hopefully as well that will translate into more visitors coming to Singapore. The last two bullet points are just about the marketing campaign that STB has undertaken with the stakeholders such as Changi Airport Group and SIA. So for this one, they are campaigning in our existing top 5 markets, whereas for this, they are casting their net wider and campaigning in a wider geographical reach. So we have some investment ideas which is almost the same as what we had from the previous quarter. Again, we are saying that all other things being equal, we expect pure play Singapore hospitality REITs to underperform peers with geographically diversified portfolios. The two REITs that are having a pure play Singapore portfolio is OUEH Trust and Far East H Trust. No change from last quarter. We still favor retail REITs with presence in heartland malls over those reliant on tourist receipts from shopping. Under our coverage, we have Fraser Centrepoint Trust with an accumulate rating, target price of 214, and it closed on Friday at 1975. This is our last bullet point is for gaining exposure to growth in outbound Chinese tourists. These two counters are covered by our Hong Kong office. So the first one is Beijing Capital International Airport. It's listed on the Hong Kong Exchange. They have an accumulate rating and a target price of 923. Last close was 834 on Friday. The other one is Shanghai International Airport, which is listed on the Shanghai Stock Exchange. Accumulate rating, target price 29 CNY, and last close was 28.26 CNY. For this one, maybe not so much of upside left, about 3%, but for the Beijing Capital International Airport, still have about 10% upside based on last close. Okay, come to the end of the presentation. We'll await the questions now. Okay, I have a question for 800 Super. How does it compare with Colex? So for, and Sam, I'm going to assume is referring to Sam Waste. So for 800 Super versus Colex, one thing that 800 Super has that Colex doesn't have is the horticultural services. So there's the business is not so horizontally integrated. Sam Waste, they also do the same thing as 800 Super. They have the waste collection and recycling as well. But Sam Waste is consolidated within the Samcorp financial results, so there isn't very much data to work on for Sam Waste. There's a question on contract value of Southwest IPC contract is 205 million. Do their contracts include any inflation-linked cost adjustment? Yes, there is some. There's a question about how about REITs with foreign exposure? Is it worth a bet? Which one? So I'm going to assume that the question is referring to REITs in the hospitality subsector. Um, Currently, actually, we do not actively cover any of the hospitality REITs. REITs with foreign exposure would have a different set of risk as well, which is the foreign currency translation risk. And then when they report their earnings, it'll be in Singapore dollars and they pay out the dividend in Singapore dollars. And then you look at where these foreign exposure are, they are mainly located in Japan, China, Australia, Europe, and some of these currencies are actually depreciating against the Singapore dollar as well. So um, that's why we said all other things equal, but then not everything is equal. Okay, so since there are no more questions, we'll end the webinar for today. Thank you for tuning in and hope to see you tune in again next week.